Good day. Thank you very much for joining us today. Today we have a very, very special presentation, and by way of showing how important this topic is, I want to congratulate everybody that's joined today. We have a really phenomenal cross-section of senior talent and executives joining us, with CEOs and CFOs, COOs, Chief Experience Officers, and I think that really speaks to the content and the importance of what we're going to cover today. So just before we get started, I'd like to introduce myself. My name is Steve Arentzoff, and I am the Senior Vice President of Marketing at FlexPay. And as we get started, just a reminder on housekeeping items. There is a Q&A box on the bottom of the screen, and feel free to use it if you have any questions, and we will get back to you either during or after today's webinar and make sure that we get you answers to your questions. So today's agenda, we're going to focus on a topic that's incredibly important for every business that has a recurring billing model. In fact, this is often the question that we get asked over and over and over again as we talk to companies, and specifically is, both what are failed payments, most importantly, why should I care, and how do I understand whether or not failed payments are causing a problem with my business? And if I do have a problem, how do I measure it? How do I understand what the full cost to my business is? And of course, once you start to recognize if there is a problem that's affecting your business, how do I start evaluating solutions? How do I look at the value they provide? How do I measure what I'm getting in return for working to fix it? So let's jump right in and start with some basics today. I think the most basic understanding is make sure that everybody's working from the same playbook in terms of their understanding of what failed payments are. And so what a failed payment is any time there is a payment request sent to the credit card system where the return code, the authorization result comes back as a decline decision. Now, on the face of it, you would expect that anytime a payment request is made to the credit card system, whether it's Visa, MasterCard, or any of the card types, that the only reason you would get a decline reason code back is that there was a fraud or the problem with the card. But in reality, Visa's own data tells us that, unfortunately, only 1 in 8 declined transactions are actually a result of fraud. And here's where we get into the really, unfortunately, bad news for subscription business. The average data tells us that almost 1 in 4, 24% of recurring subscription payment requests are declined. And because we see the data, it really tells us that almost all of the reasons codes that come back on these declined transactions are false decisions, meaning they're bank errors that are being made on the payment request. We'll go into a little bit about why that occurs, but just to get centered, what's also really important to recognize, if you have a subscription business or any business where you're using credit cards for recurring payments, is that the business model itself is incredibly attractive, right? We have the ability to create very special relationships with our customers. They put trust in us. They sign up for recurring delivery products or services because they love what they're getting from you, and that gives you the ability to establish an ongoing relationship that's much deeper than a transactional relationship like a traditional merchant has with a customer. But unfortunately, because of this business model, you're also uniquely vulnerable to payment issues, because if there is a failed payment that occurs that cannot be resolved, the cost of the business is much more than just a lost transaction. It actually creates churn, what we call involuntary churn, or churn that's created when the customer itself is not asking to end the relationship, but a factor gets in the way, like a declined payment, that prevents the subscription relationship from occurring. So the obvious questions, though, that we want to answer are, if I have a problem, what is it? What is my failed payment rate? How do I measure that within my business? And of course, the leading next question to ask is, if I do have a failed payment problem, how many customers am I losing as a result of failed payments? And how do I measure what cost it in parts of my business? And of course, if I do put a solution in place to reduce this, how do I properly evaluate and measure what value it's providing back to me? These are the really 4 fundamental questions and the answers that you need to deliver for your business. We're going to go through in depth today. And of course, we're going to talk about all the different factors. We're going to talk about what data to be able to collect at a very high level, but more important, we're going to talk about the questions to ask internally and what teams to get together to be able to to pull this together and be able to answer it, and really use this session as a jumping off point for starting to address this within your business. And we'll give you support and help along the way to be able to do this. Now, as I said, even unfortunately, subscription businesses, the business model itself means that the businesses are susceptible to failed payments because of the fact that a failed payment that's not resolved causes an actual churn customer. Now, unfortunately, what the data tells us, as I showed before, is that the data, again, we get from Visa, and this in the case was a Visa and a Walmart study showed that they tracked consumers across different channels of purchases, whether they were in person or whether they went online, were buying, making purchases through e-commerce or recurring. And the unfortunate fact is that while the subscription business model is uniquely susceptible to problems from failed payments, what's even worse is that the credit card authorization systems treat recurring payments as a special type of transaction. And what that means is that they're held to a higher standard, or they believe there's more fraud involved in those transactions inherently. So the decline rate for recurring billing transactions is actually the highest in any type of online transaction. And as we showed before, unfortunately, 2/3 of these payment declines are caused by false declines. So what that means is that for subscription billing models, you are going to experience a failed payment rate that is unfortunately quite high and painful, and that in the majority of the time, the reasons that the customers' cards are being declined is not because of bad cards, not because they're associated with fraud, because of errors, bad decisions being made on the cards. Now, that's the bad news. The good news is that there are solutions to be able to resolve this, to be able to recover the transactions, and most importantly, to be able to recover the customers that otherwise will be lost, excuse me, to involuntary churn. So, as I mentioned before, we're going to take you through all the calculations you want to start creating and calculating and measuring within your business. We'll introduce them to you. Certainly don't expect to know all the individual calculations that have been made or the data elements we put together, but we have created a series of assets for you to use as a reference point. These are wonderful guides to be able to share with your internal teams, to be able to pull together the right people from finance and technology and customer support, to be able to gather the data, to be able to pull information from your billing system and your CRM system, and to start to measure these numbers for yourself. And I can guarantee that once you start to look at these numbers and view them and measure them in the ways that we're going to talk about, it's going to be quite eye-opening. So if you look on your desktop, there should be a little icon that is blinking. That link will take you to a web page that we've created that will contain a detailed list of the data to pull together and the calculations to make to be able to drive the development of the reports that we're going to go through today. Similarly, there's a web link here, a web address, flexpay.io/measuring-involuntary-churn. Again, that address will take you to the same page. And we're also going to provide an additional level of support for everybody that attends this webinar that I'll talk about in a little bit. But a really neat way for us to provide a direct level of support for you to take you through this process internally and help your team start to uncover these assets and create the reports and the metrics you really need to be able to optimize your business performance. So let's dive in and start talking about the individual calculations you really want to make. The first calculation we'll go through is really the starting point, and that is the calculation for measuring your failed payment rate. If this is something you're not tracking internally, I strongly suggest you immediately start getting on this number and tracking it. And it's a vital number to really understand a number of additional metrics that we'll create and calculate subsequently. So the failed payment rate conceptually is a very simple number. It is the ratio of how many payments you submit in total for a period and how many payments within that submission are failed. And that's the percentage you want to calculate. So what is the percentage of payments that are declined? As I showed before, the Visa data tells us that about 24% of subscription payments are declined on average. It really varies by business and business type and the customers that are the customers of the businesses. We see ranges of declined payments in the low end from 10-15%, and we see them as high as 50%. So it really does vary. But the fact is, virtually every business that has a recurring billing model has a problem with this. So starting with an understanding of what your failed payment rate is absolutely vital. Secondly, now we start getting the interesting parts, answering the question, okay, if I now know my failed payment rate, I really want to know what percentage of my total churn, how many customers am I losing that are caused not by what we call voluntary churn or customers choosing to end the relationship, but the involuntary churn that is created as a result of a payments problem. So again, this calculation is relatively straightforward. It's the percentage of total churn that's caused by failed payments. You divide your churn customers by the customers that were identified as experiencing a failed payment that was not recovered. And it's very simple, right? If the subscription customer has a failed payment that is not recovered, then that customer inherently is lost to you. That is your involuntary churn rate. Again, let's talk about what that typically looks like for subscription businesses. Our data within FlexPay shows us that the involuntary churn rate can be as high as 48%, almost half of all customers. For most subscription businesses, this is probably the biggest secret or our knowledge point that's missing is that the single largest source of churn are failed payments and not the factors that most companies invest in. Now, almost every subscription business will invest in customer support and the product experience and other attempts to try to improve the customer loyalty and customer stickiness because the inherent business model is dependent on trying to extend out the customer relationship as long as possible because that drives profitability. But the unknown truth, if you will, is that if up to half your churn is actually being caused by involuntary reasons, what that really means is that of all the efforts that have been deployed to impact churn, they're only have the opportunity to fix or address half of your churn. So the identification of how much of churn is caused by involuntary rates can be an eye-opener because, again, it really gives you a window in how much of your customers are being lost to reasons that you're probably not addressing today. So now the next step is, once we've identified our churn rate, is to start to factor out and start to connect the dots that the lost customer is not a transactional loss. As I said before, when a failed payment occurs and it's not recovered, the entire customer is lost. So the way we want to measure the cost to the business of a lost customer is not the single transaction of the monthly failed payment, but the estimate of how many future billing cycles that customer would have made, the forecasted lost LTV of that customer. So we can break this calculation into two pieces. The first step is simply looking at what's our estimate of how many billing cycles we expected that customer have versus how many actually occurred. And the way to be able to do this is pretty simple. You should have a view into what the average lifespan of the average life cycle of your customers are. And when you measure out when that failed payment occurred for a customer, you can simply take the difference, and that'll be your estimate of how many billings cycles were lost for that customer. Pretty straightforward. Now, the next step, and this is probably one of the two most important calculations and insights that we'll talk about today, is that once you have the average, the estimated number of billing cycles that are lost, is actually calculate what that means in hard dollars to you. So the way to do that is to calculate out the number of billing cycles that are lost and multiply that by the AOV, the average order value, the amount that customer was paying you, and that will give you the estimate. So as an easy example, let's say that the customer, the average lifespan of a customer within your business is 10 billing cycles or 10 months. They experienced a failed payment in month 3, and that was not recovered. So in that example, there are 7 billing cycles that were lost, and if we assume that the billing amount for them on a monthly basis was $50, then that comes to $350. This recognition that the total value of that customer lost is $350 and not $50 is incredibly important to recognize because it really speaks to the heart of the total pain that failed payments causes your business. There's going to be two main points I really wish you to walk away from today. One is the understanding of how to calculate the total cost of failed payments. And conversely, which we'll talk about next, once a system is put in place or technology to resolve failed payments and recover the customers that otherwise would be lost to involuntary churn, is to be able to calculate how much value is being recovered, how much extra revenue is being created as a result of the customer relationship extending. Again, this is a fairly simple calculation. It takes a little bit of time. What we want to be able to do is once a customer has experienced a failed payment and has been recovered, is start tracking month after month after month how many billing cycles you're able to achieve with that customer and multiply that by the monthly billing amount. That will give you the total value of a recovered customer, the sum of all future billing cycles. And the reason this insight, this data point is so important to track, because once you start to recognize that the revenue that accrues from a customer that's recovered is many, many times larger than a single recovered month of transaction, then that really focuses efforts on how much effort should be put into recovering the customers. I cannot emphasize enough how important this concept is to be able to measure the value of a recovered customer properly and put the right amount of effort. The ability to transform your business's growth, your profitability is truly transformational when recovery systems are applied well. And to bring that to life, what I can do is go through an example and show you exactly what that means in real life terms. So this is a composite customer of ours. And these numbers that we have here are good averages we see with customers. So let's say that there's a business where the dollar amount that we average bill customers is $50. They have 10,000 active customers. And to make the math easy, we're going to keep their failed payment rate at 15%, which actually is, sort of in the middle. Again, as I said before, we have customers on the low end of 10%. We've seen customers as high as 50%. So 15% should be an reasonable estimate. And we'll keep their growth rate at 15% also. So in this scenario, this company is experiencing flat growth because for every customer they acquire, every dollar of revenue from a new customer, they're leaking it out the bottom for failed payments and involuntary churn. So let's assume in this case that the average customer life cycle is 8 months. So in this example, we're going to assume that 30% of the customers lost the failed payments. Is 30%. And there's a cost to that of $15, but it's almost immaterial because the amount of revenue that's required for recovered customers becomes very, very substantially part of the overall growth rate of the company. So let's go through the example. So in month one, 30% of the 15% of losses equates to $22,500. And if you're interested, ask the question. I can certainly follow up with you and give you the detailed math behind this. But what we see is that as we start to look at the compounding effect of customers living and contributing revenue in each month subsequent after recovery, it becomes very substantial. So in month three, we have the customer that's recovered in month one, also billed successfully in month two, but we also have a new group that was recovered. And that stacks up with the customers living on and continuing to bill successfully and new groups of recovered customers being added. So what appears to be simply a value of $22,500 being recovered when you look just at the month of recovery translates into something very, very different. So this is an example. We have, after 6 months, the apparent value of customer recovery being $22,500, which is what can be seen on payments recovered. When in reality, that means that in month 6, just in month 6, that there's $135,000 in revenue that are being contributed by customers who recovered that would not have existed otherwise. And what this means, the value and the power of the compounding of these customer cohorts that have been recovered is that in this example, in month 6, 27% of the total revenue of the company is coming from those customers that are recovered. What that means is if the recovery was not in place, the involuntary churn was at that 15% level, that revenue would not exist. That's what I'm talking about, is the value of compounding customer returns from LTV of recovered customers can deliver a growth rate to recurring billing models, subscription businesses, that simply would not exist otherwise. It really has the ability to transform in a very substantial way the overall financial performance of companies. And just as a fun data point, in this example, when you look at the total revenues recovered after a 6-month period, again, we're looking at just $22,500 in a single month. The total revenue recovered of 6 months is $472,500, assuming that those customers maintain a lifespan for 6 months. So again, the compounding impact becomes a very, very large number. And the profound insight that I hope everybody really understands is that by being able to add more revenue to the company, by being able to improve the LTV of customers, it dramatically improves revenue. It drives growth of the company in ways that wouldn't exist otherwise. It drives profitability. And that allows subscription business models to reinvest in acquisition, to be able to put more into customer growth, to be able to invest in the product experience, to also help improve overall customer retention. It gives you the ability to build market share and build sustained competitive advantages against your competitors in ways that really no other technology solution or investment will make. And I think the the key insight here is that those companies that are able to recognize this truth and be able to invest in the failed payment solution first are going to gain a speed to market advantage and be able to gain access to these sustainable advantages and leapfrog their competitors because of the ability to invest more in growth and gain share in a really unique way, which is incredibly powerful and incredibly important to recognize. Okay, so in summary, we've talked a lot about here, but again, there's resources that we're going to talk about that will help you start to uncover these insights for yourself. In summary, just to recap, one, the subscription model is uniquely vulnerable to both involuntary churn for failed payments, and fortunately, it's disproportionately impacted because of the way that the credit card authorization systems treat transactions on recurring billing. Two, if you're able to reduce the involuntary churn that's created by failed payments, it has the ability to deliver compounded returns that become sustained and provide a really strong, unmatched competitive advantage, giving you the ability to unlock market share growth that it really is not possible in no other way. And finally, and this is something that I think will be incredibly helpful to most companies that are joining us today, is that help is available to you to really start to unlock these insights, measure these values for yourself, and start to take the first steps to solving them. As I showed before, and as the links within the desktop, there are resources we're providing to you if you want to self-serve and look at the calculations and start to uncover these for yourself. But we're providing a very unique resource for you today for people that are joining us on today's webinar. Our professional services organization normally charges companies to go in and go through this process, conduct the audits, to gather the data, and start to build the reporting systems. But we believe so strongly that these insights and these learnings and these results are so important for subscription businesses that for people that are joining us today, we're given the opportunity to take advantage of a free consultation. This will include our internal services team taking you through this process directly. So instead of having to use our resources and add it to your internal team members, we'll take them through it. We'll take you through how to calculate the involuntary churn. We'll give you access to the tools and the calculated data for forecasting how much compounded losses you're losing by the failed payments and the sustained customer losses over time. We'll provide the forecast of how much annual revenue you're losing, looking at the LTV lost, and we'll also go through and review your payments tech stack and provide guidance on where that can be upgraded to be able to insert a failed payment solution that will solve this with the best possible results for you. If this was too difficult to go through the system, I also want to invite, just simply email me and I will connect you to our professional service organization. So you can send an email to sarenzoff@flexpay.io. And again, I'm happy to help here in any way I can with your business because this is such an important problem to solve. Great, so this takes us to the end of today's presentation. This is a QR code if you want to use this as a third mechanism to be able to connect with our organization and request the free consultation. Now, let's go see if we have any questions today from the webinar. We do have a couple questions. Great, so the first question is, can you talk about the biggest myth in failed payments? It's a great question. I think probably the biggest myth in failed payments is that the belief is that the payments system, the credit card authorization rules work the way that they're intended, and vet each transaction or identify fraud accurately. And we just know from our own data experiences we have, in fact, the data that MasterCard and Visa published, that this is unfortunately just not the case. And this rate of failed payments occurring for recurring billing of 24% as published by Visa is a pretty telling metric of why that is not true. And the recognition that for every subscription business to really optimize their business, they have to recognize this truth and manage it to the best they can. Work with a company perhaps like FlexPay who has a solution to help solve this problem. Hope that makes sense. And then two, my second question is, can you validate that the LTV approach is appropriate for calculating the losses and the revenue gains? Great question. I think this is probably maybe not the second biggest myth, but probably the second biggest mistake that most subscription businesses make is that when they look at, for those businesses sophisticated enough to recognize failed payments and track them, when they look at the losses their business occurs as a result of failed payments, they will track the monthly losses and failed payments that are not successfully completed. and that becomes their measurement of what their losses are. And they fail to recognize that the churn that's created as a result of those failed payments is going to cost pain month after month after month for the lifespan that would have occurred in the absence of that failed payment. And by the same token, when they do put efforts behind trying to recover customers, once you start to recognize that the LTV measurement is the most appropriate way to track the value of recovered payment, the reason that knowledge becomes so powerful is that you recognize that your goal becomes not just to be able to recover a failed payment, but also to do so in a way that maximizes the lifetime value, the retention of that customer after the recovery. So developing an invisible or very positive experience to be able to work with the customer when needed, to be able to recover the customer, to maximize the retention of the customer post-recovery is most important. That's really what the answer is, to be able to give you the most additional value of a failed payment, of a customer following a failed payment. Okay, that brings me to the end of the live questions, but feel free to put any more questions you have in the question and answer box. If you happen to watch this webinar on demand, we will continue to look at the questions and answers and get back to you. I want to thank you so much for joining me today. It's been an absolute pleasure. As I said at the beginning, this topic is of utmost importance to every subscription business. So I really hope that this was useful for you in helping you to get started on your path to starting to record properly the cost and the benefits of both failed payments and what the recovery solutions can mean for your business. Thank you so much.